All right, everybody, welcome to Winners, Wallets, and Worldviews. I'm your host, AJ Armstrong. You can follow me on Instagram at AaronArmstrong33. That's Aaron Armstrong 33. You can go to my website, aaronjarmstrong.com, to learn more about me, this podcast, as well as any other questions, or if you guys want to work together in the future. Now, today I wanted to bring a little bit of a different flavor to the world of personal finance. And we talk a lot about real estate on this show and how you can be an investor. So I wanted to bring on a guest that we could talk that provides financial advice that still kind of follows consistently with my general Dave Ramsey kind of flavor as far as personal finance, but also can talk to the idea of real estate, pure lending, some of those other aspects that we've discussed many times on the show. So we found a guest, and he was really a great time discussing a lot of these topics and kind of the philosophy that guides them, and just a powerful, powerful discussion that we saw today. So the guest we had on today, his name's Jerry Fetta. He is the owner and founder of Wealth DynamX. So his goal is to pursue financial knowledge and make money, but keep more of it and multiply that so you can be financially abundant and prosperous in all aspects of life. Jerry was a student of many different people you might follow: Grant Cardone, Dave Ramsey. He's been involved with many of these folks. And, he's been a fantastic, phenomenal entrepreneur himself, building up this business called Wealth DynamX. So without any further ado, I want to let you guys listen to this episode to learn personal finance from a little bit of a different lens than you're typically used to viewing, but something that would be really easy to jump into and get started with. So without further ado, welcome to the show.
Welcome to Winners, Wallets, and Worldviews, the only show that's going to teach you how to be somebody.
Where in your life did you learn that you're not good enough?
Take what you're most passionate about and what you're most fearful of, and what is the plan to overcome that fear, and what is the plan to enact that passion.
Well, everybody, welcome to Winners, Wallets, and Worldviews. I'm your host, AJ Armstrong. You can follow me on Instagram at AaronArmstrong33, or you can always go to my website, aaronjarmstrong.com, and you can go aaronjarmstrong.com/podcasts, where you can listen to this podcast as well as many others. On the other line, we got Jerry Fetta, who's a wealth consultant and advisor, and he's going to teach us some pretty incredible tips and tactics on how to manage your personal finances. And we might have some cool discussion on maybe some conflicting views you guys have heard in the past, of some recommendations from maybe your parents, or you might have heard on the radio or other places. So without any further ado, welcome to the show, Jerry.
Hey, thanks, AJ. It's great to be on. I appreciate you having me on today.
Yeah, brother, it's an absolute pleasure getting you on the show. So can you give us a little background, on you? What was your upbringing? What was your childhood like, and what kind of led you into getting interested in the world of wealth management?
Yeah, that's a very good question. So I grew up mostly in Alaska. I was born in Montana. My parents, we lived there till I was about 5. Then we moved up to Alaska, and so I lived there from 5 till I still currently live there now.
What part of Alaska?
Anchorage.
Oh,
I grew
yeah.
up kind of, there's a like a little kind of rural area near Anchorage. I grew up in that area, but I live in Anchorage now.
Right
Kind of
on.
the real city there. They say
Yeah.
that's the closest you can be to Alaska without living there.
Yeah, I got some buddies in the military still that are stationed up there. So
Yeah. So that's kind of, where I grew up, and my dad was military. My mom, she supported the household and took care of the kids. And, my childhood, as far as money was concerned, like my parents, it wasn't really a thing we talked about. My parents were not very good with money. So I remember being a lot of times, paycheck to paycheck. At one point, the house, we lost it. The car got repoed. I
really,
remember seeing these things when I was a kid. And ultimately, for me, my parents ended up getting divorced, and money had a lot to do with it. So as a kid, it was like an area that I wasn't very keen on, if you'd say that. And there's a lot of problems attached to it.
right? Yeah, that's interesting. So I mean, what does that do for a little kid? Like, I suppose there's lots of different ways someone could approach that when you're noticing these things, because kids aren't dumb.
Mhm.
You see your car get repoed. You see, late red pieces of mail. Like what's going through your head at that point as a child? Like, what age was this going on?
It was probably around like, kindergarten, first grade in that
Yeah,
age. So I was old enough to start to be aware of things. I don't think I had any idea of what it meant that the car got repoed. I just know we had a van and now we don't.
right.
Um, or we lived in this house and for some reason we're moving out really fast. So those were like things that I think later I was able to connect the dots on and realize like, oh, that's, called a repossession of a vehicle. And these are the contexts in which that happens.
Okay, so then you're 18 or whatever. Do you leave the house? You go to college? Like, what happens after there?
Yeah, so I didn't go to college. My dream in school was to be a bodybuilder. So I did competitive and amateur bodybuilding, and I did that, from the age of 16 probably till about 21 or 22. And so when I left school, that was my dream. I was like, man, I'm going to be a bodybuilder. I'm going to open a gym. I'm going to be a personal trainer. And I did do that. So I literally, graduated, got my diploma, went over and started training clients. And so that was kind of, right after school. And it was through that where I started noticing, like, not even the money side of things. I started noticing the entrepreneur side of things. I realized at the gym, there was not anywhere else for me to go to. I got
Sure.
promoted from entry level personal trainer to head personal trainer in my first 6 months, and I was 18. So I was like, dang, I suppose gonna have to die or quit because there's no more spots. Like I can't
Yeah.
go up any higher on the org board here. And so I started seeing that, and there was a couple instances where I started to realize, like, I really didn't like having a boss, and that was kind of like where I started looking at, what else is out there. And I ended up finding the financial business, which wasn't even on my radar. It was not something I'd dreamed of doing. I didn't even consider that I would end up in that industry, ironically enough.
That's funny. Your story kind of reminds me of Marissa's story, my wife, who she started in the bodybuilding community while she was going to school. And when she got out of school, she got her first job as a personal trainer somewhere. And it was the same kind of thing. Like, just in her head, I could do this better. The way he's treating the owner at the time, the way he's treating his clients is so much different than the way I would treat my clients. And it's kind of interesting how I was with her at the time and just watching her go through this, like, aha, wow, the world doesn't have to be this way. There doesn't have to be a ceiling to your career or your profession. You can go outside and pull in clients your own way. That's
Yeah.
kind of interesting. Your story reminds me of kind of how she came to find entrepreneurship in a way with the fitness community.
Yeah. Yeah. And I think that's a lot of it with an entrepreneur. We have that desire to make things better.
Mm,
And sometimes that's good, sometimes that's not.
right.
Time dictates which one is which, but I think that that's totally true. Is this disdain for, I could do a better job at this, or the system could be better, or the service could be better. I totally see that.
Yeah, that's it's kind of an odd transition to go from, well, I guess to maybe an outsider looking in, it might be an odd transition to go from fitness to entrepreneurship. But I've noticed, especially just in observing feedback and people listen to this podcast, like, this is a podcast. We talk about a lot of different things. We probably talk more about wealth building, entrepreneurship, small business, things like that. But we bring in health, we bring in worldviews, like, winners, wallets, worldviews. That's the show. But I've noticed the people seeking, that kind of motivational content, or that kind of
Mm.
like those kind of fortitude virtues, self-reliance, like motivation, like taking ownership, responsibility. It's very similar to where health professionals find that because of the nature of the health business, and
Yeah.
it translates really well into personal finance, and it translates really well into the idea of like wealth building and taking accountability for your own situation and having financial fitness, if you will. And I know that sounds cliche, but in a way, they're the virtues that drive someone that's successful in health are the same virtues, I think, that drive someone in finance. So it might seem to like an outsider that your story transitioning from health into as a financial professional is like this some different industry jump, when in reality, I think it is relatively consistent with probably how you grew up and the things you were working on training as a bodybuilder.
Yeah, there's a lot of parallels there. And for me, like, kind of what made me make that jump is I had a mentor of mine that he got into that industry. So he was working with the company, and he got licensed and was helping people with, life insurance and investments and things of that nature. And he had been trying to recruit me, and I had no interest. I was like, no, this is, you're doing your thing, I'm doing my thing. I appreciate it. But, I was at the gym and I got there to a point where I started, like I said, I got promoted to being a head personal trainer. What that really meant was salesperson. So I was no longer training people. I was selling personal training packages, which I didn't know at all when I got into that job. And I remember I sat down one day with a client and I closed the biggest training package that the gym had to offer. And I was like blown away. I was like, wow. And it was only like $4,000, but for me back then, $4,000, it was a big deal. I was like, wow, that's a lot of money. I just closed $4,000. So I'm
Right.
sitting there thinking about, okay, now I've got this client and I have the thought of, I wonder what I just made. And so I go and calculate the commission, and I always like to have people guess. What do you think I made on it, AJ?
What, 5%?
I don't even know what the percent would be. I made $20.
I think that's 5%, isn't
Is
it?
that 5%? I think that is
You're
5%.
gonna make me do math hard, dude. We're gonna use a calculator so that we don't mess this up. No, 5% of 4,000 would be $200. So you
Yeah,
got 0.5%.
0.5%, half a percentage. So I was upset, to say the least. And so at the time I called my friend that was trying to get me in finances, and I was like, hey, I don't know what you sell, but if I sold $4,000 with you, what would I make? And he's like, well, you would have made half. And I was like, come again? He's like, you would have made half. And so I was like, I couldn't wrap my mind around that. I was like, I would have made half. That's $2,000. That's like what I make in a month. So I was interested enough to then go sit down and have a meeting with him and see what it was. And I remember when I actually sat down, what I saw, and it's exactly what you said, was that people needed help with finances. The same behaviors and things that people are dealing with in fitness, they were dealing with in finances. Now, with finances, I could do a lot more about it because there's a lot more behavior monitoring and services and planning that I can do. With fitness, it's kind of like eat less and work out
Yeah,
more.
unless you're gonna
And
feed me, right?
unless you do that, I can't help you. And so I kind of saw that aspect and is like, man, this translates over really well. And that's where I went back to my parents, paycheck to paycheck, debt, all the stuff that the average American is struggling with. And I saw like, I can't know that this is happening and know there's a solution, not go do something to help. And that was kind of what got me in the industry.
Yeah, that's interesting. Kind of reminds me of that scene in Wolf of Wall Street where he gets canned from working on Wall Street and then he moves in to work at that penny stock trading firm. It's just like some strip mall, and he goes in and they're just like, hey, he's like, well, how much commission do you make on these? There's just something like 50%. And he's just like, 50%? You got to be kidding me. Because, he's like, because he's got to push these products a lot more. So he obviously earns the commission back. But that's funny. That's just an interesting movie for people to watch, that clearly you should have a responsible audience, if you're going to watch The Wolf of Wall Street. But it pulls some good, I think, business values by watching a lot of poor business values, one of those kind of stories. But back to your story. I've seen on your website and some other places, you kind of have a really simple way of educating people in the world of wealth that you use a lot of images and graphs and diagrams, and a couple of them are like, like the triangle of wealth building or whatever. Can you tell us a little bit about a couple of those tools? Because I like to use tools as well to explain things to people that are much more complex to simplify it. So can you go into that
Yeah,
a little bit?
totally. So anyone that's listening has probably had an instance where money was confusing. And as a wealth coach and as a business owner, I run into it a lot where I run into people that I'm talking to them about money, and I'll have almost 100% of the time they'll say something along the lines of, for some reason when it comes to that finance stuff, I just can never seem to get it.
Sure.
And
Financial illiterate, right?
yeah, and there's a lot of potential reasons for that, but the biggest one is that at the point where someone doesn't get finances, we're no longer dealing with finances, we're dealing with vocabulary. Finances is math. Math is simple. Everyone does math, add, subtract, multiply, divide. I have never met an adult yet that couldn't do that or couldn't do a calculator and have the calculator do that. So it comes down to like the actual nomenclature and the specialized language, and a lot of that's built into it to make it more complex so that people feel like they need to hire somebody. If there's no stupidity, then there's no reason for there to be a professional.
Sure.
And so what I do with these graphs is I take concepts like, wealth, and I break it down into, at the end of the day, you got to earn money, save money, invest money.
Yep.
So I made a triangle, and the 3 points of the triangle are you've got to earn, you've got to save, you got to invest. And I did that in response to, I think it was 2 or 3 years ago, there was this really big, at least on my Facebook feed, this really big rage against saving money. Savers are losers, never save, borrow everything, which is like, extremism, and there's never black and white polarized of anything. It's always
Right.
somewhere in the middle. So I was trying to figure out, like, how do I help these people realize that you have to save money? If you don't save money, there's nothing to invest.
Yeah.
And so I was thinking about, okay, well, we could tell them we could keep money or we could store money. And I was trying to think of all this other stuff. And then finally I was like, no, you save money. Like, we're just going to confront the fact that saving is a thing and you do it, and it's not for losers, and it helps you have money to invest. So I made that triangle so people could see, if you earn money, you need to be able to save it. If you earn it and don't save it, then that's not good. Okay. If you save money and then don't invest it, because that's what all the savers are losers people were hung up on, is people saving money, but then not doing anything.
Right.
That's bad. Yeah. But if you invest it, it's good. So that triangle gives the visual attachment on, those are the 3 points that have to happen.
Right. Yeah, that's a good point you make, because the classic advice, I think, that why people hate the idea of saving is because that's what your parents told you, or that's what, society told you. Is just like, you make money, you save money, you make money, you save money, but then it sits in a savings account that probably doesn't even beat inflation, and it becomes a problem. So then, all the self-help motivational people and the financial guru says, no, don't save money. You should be investing this money. And it's like, well, that makes sense. You don't want to be sitting on cash that's dead. So they decided to go like all the way in the other direction, to kind of like rip apart this narrative of just making saving and looking at investing, because now you get the beauty of compound interest, the possibilities of passive or residual income, and these other, and starting a business or whatever you want to do. Right.
Yeah.
And I think that you bring up a good point that says, let's come back to the idea of saving is still important, but investing is still important. And I think that there's a nice three-way triangle you have here, because earning is also important. This happens a lot with people. Someone asked me the other day, they say, why don't you spend more time, with all this real estate stuff going on that I have going on? And I'm just like, well, because some level you want to be able to cash flow to put money into a real estate investment. So I know some house flippers, for example, that flip homes as their business. And this guy is super successful house flipper in our area. And we were talking to him, and I was really impressed. He's done over almost 100 flips, right? This is what I was talking about the other day. He almost did over 100 flips. And he's just known in the area to do this HGTV kind of thing. He's not on the show, but he said, like, yeah, it's awesome. I know I'm running this business or whatever, but he's like, when I break it all down, I'm making like $30 an hour for all the work I put into it.
Yeah.
And it's like, oh, okay. So you really want to put in all of that work when you could have a job that makes $30 an hour too, and you could just be investing that into real estate and then do nothing. So I guess I like that other point you make, the earn point. Like, and that's one of my good mentors told me that right away when I said I wanted to go into real estate. He's like, the thing is, you're going to want to figure out some way to cash flow. Like, you want something that's going to pay your bills, something that's going to consistently come in. You can start a business that does that, but you want to make sure that that's part of your plan. That you're not just going to like sit on a property and, yeah, you could hit a jackpot every couple years that could do a couple 100,000 or a couple million, but there's nothing in between those years, and that could be uncomfortable. So long story short, I like the three-way paradigm you have kind of going on here. You've got the earn, that's important. You've got save, that's also important. You have invest. I'm going to ask another question.
Yeah.
Like, I follow and listen to my boy Dave Ramsey, right? I usually, people don't know much about wealth, I kind of refer them to him. I'm probably 85% in agreement with Dave on most issues. There's a good handful of issues I disagree with, but what is the right amount to save? At what point do you stop saving and focus more on investment? I know Dave's got some rules with that. I'm curious to hear your flavor.
Yeah. And it's funny. I don't know if you know my background. I was a Dave Ramsey endorsed local provider for like 4 or 5 years.
Right on. Okay.
So I'm very familiar with the Dave message. I think that Dave's, like you said, there's things that Dave says I totally agree with. And then there's other things where I disagree, and not from the standpoint of wanting to be disagreeable, from the standpoint of, I think at a certain point, it becomes vast enough where you can't blanket statement everything to a radio listener group.
Right.
So he keeps things very simple, and I don't think a lot of people see past that, so they get stuck in that vein. I totally agree with Dave on, you need to have a budget. Now, I don't do beans and rice, right? So I talk about, you should have, your food, your transportation, your shelter, your clothing, like all the basics. But the ones that Dave misses are education and health,
Okay.
right? Because if I don't do education and health, then I end up in poverty,
That's
and
a
I
great
can't
point,
build
though.
wealth
You're
in
right.
poverty.
You're right. Dave does not talk about health because that's a big part of your budget is the type of food you buy.
Yeah.
And I
Going
think
to the gym.
there's strategies and hacks that you can use to try to get like healthier, high quality foods. My wife and I fight about that all the time because she goes for like the top of the line types of foods, and I'm okay with like middle of the road, not bad quality, but like I'm
Yeah.
okay with middle of the road quality food. But it can be 4 or 5 times as expensive. So you have a couple or kids or anything, you add that multiplier in of 4 to 5 times your food costs, and your grocery budget could go through the roof. So I'm glad you mentioned that. And what are your thoughts on that? Like of how much to invest in, like when you're looking at groceries, or like what kind of hacks and tips do you have for people to kind of help navigate that?
So with food, I guess I don't really have any hacks. I would just say earn a lot.
If
Earn a
you want
lot so
better
you
food.
don't. Yeah, like I do eat organic, and my mom died of cancer when I was 22 years old, and so she was only 60, and so I'm very conscious of like the chemicals and different things that are in food that we might not know is in food. And not to the level that some people may be at on, I don't spend time researching these things, but I'm aware, like if it's not organic, I probably don't want it in my body.
Right.
We just watched the movie. I don't know if you've seen the movie Dark Water.
Oh,
Is the
don't tell
whole
me another movie on fitness, dude. My wife is going to make me watch that.
not
And
fitness. It's
okay.
DuPont. They did Teflon. Like
Okay,
Teflon coated.
good.
So the whole movie was about how they were poisoning the water supply and the communities around them. And so like that's a real thing, and it happens with food and water and household appliances and different things.
Right.
So I don't really have any hacks on like if you're grocery shopping, use this or that. It really is like earn a lot of income so that you don't have to worry about feeding your family something that's going to give them diabetes or not.
Right. And I'm with you there. There are some foods, like I guess it depends on the health philosophy that you abide by. If you're a vegan, like we did the whole raw vegan thing for a while and got over that, and then now we kind of have a more balanced approach. But like going to your local, like knowing local farmers to provide you eggs, for example, you can get
Yeah.
free range chicken eggs that are sold at a very cheap price, and eggs are a great source of protein and fat. And you have the opportunity to buy those really inexpensively. But the one hack, I guess I've talked about this a little bit, I think before on the show, but there's a website called eatthismuch.com, and it lets you put in your flavor of diet philosophy. So if you said paleo, and then you can put in all your credentials or all your info, and it automatically calculates meals for you. But it can also help you reuse as much food as possible. So it's really efficient, probably more efficient than you would be in your own house. It'll look at, because you can store things in a pantry, a virtual pantry, and it'll pull recipes from things you have on inventory.
Oh,
And I found
nice.
that to be like crazy, because you can get your meals down to like $1.50, even high quality meals, and it's calculating that for you. And if money is a problem, you can put that as one of your constraints in this software. And it's like $5 a month or something to do this. And I found it to be really helpful if you're looking to eat well, consistent on a budget. So
Yeah.
something, interesting to think about. And I was curious if you knew anything of like that, but it's a cool idea that you bring in health, because Dave definitely misses that for sure. But anyway, back to your triangle, the second or the second piece of this.
Yeah, and you had asked about when to stop saving. So I'll hit that really quick. So I mean, with saving money, basically you're building solvency is what you're doing, and that's I think the number one thing America is missing right now in the American households is financial solvency. So I totally am on board with let's get rid of debt. I think a lot of people get trigger happy with investing. Let's say I have 10 grand and I say, man, I'm going to put this into a deal and make 12%, which with 10 grand is not the easiest thing in the world to find. But let's say I could, I'm going to make $100 a month, right? If I take 10 grand and I pay off my car, I'm probably going to make $300 to $400 per month. So when I just look at cash on cash return,
Mm-hmm.
I'm gonna have a much better cash on cash return just getting rid of my debt. It's kind of like trying to run on a treadmill and the treadmill's moving faster than my legs are. So I
Right.
like to say get rid of that. And then I do think 6 months is pretty good for savings, right? Having
Yeah. So
6 months
Dave
of
has like
reserve.
what, 6 to 12 month rule or something like that.
Yeah, and I think 6 is on that line where you're good. I'm not afraid of credit. So 6 months of expenses and savings, and have 6 months of credit just in case you need it. If we've gotten out of debt and we've changed behavior, then we're not going to have an issue having access to credit. You're not going to go charge it back up again. You've changed and learned not to do that.
Right.
So that's kind of my stance on it. At that point, we start investing, and I'm very big on investing only for passive income. So we don't do anything in the stock market. We're not messing with financial products. We're looking at real assets that pay monthly passive income, so that an individual can incrementally buy back their time. They're able to get that flow every month, and after enough of those flows, they can quit their job and actually be financially free.
Sure. Before we jump into what some of those investments might be, what is your philosophy on debt? You know, you have Dave that's kind of like, he won't even buy. He'll let you buy a house, I guess, 25% down, but he won't let you buy real estate portfolio or a rental property or anything like that if it's financed out. Where do you stand?
So I don't think there's any such thing as bad debt. I think there's just bad behavior.
Okay.
Debt's inanimate. So I think that if debt does not pay you, then you don't need it. For example, like a car loan, a lot of people I hear justify the car loan like it's a cheap, low interest rate. Instead of a car loan, what I do is I put money in my life insurance policy, borrow against my life insurance policy, purchase my vehicle with the cash from that, and then make a payment to myself. And the difference there is we look at stats, I have a higher savings rate and a lower debt to income rate. So statistically, that's a better move for me because I'm able to have the car, not to get too complex, but I do something called the Section 179 where I write the car off, and I still have it growing for me while I make that payment to myself. And then in 5 years, I do it again. So if I can make debt work for me and cash flow, then it makes sense. If I can't, then it's just increasing my debt to income ratio, which is reducing my savings ratio.
That's interesting. Tell me a little bit more about borrowing off of a life insurance policy. I don't know if I've heard a lot of people do that before.
Yeah, it's kind of funny because if you're a Dave guy, that's the devil. Like Dave is 100% against whole life insurance.
Yeah. I don't have whole life either, but I'm always interested in another perspective.
Yeah. So I use this all the time now. Basically, there's a specific way that if you structure a whole life insurance policy, you can set it up to where essentially if you put $1 into it, that dollar is going to grow at a 3 to 5% annual growth rate, tax-free. While it's doing that, you can borrow 70 to 90 cents off of that dollar at like a 2% interest rate and still be making the 3 to 5. And so I would go use that dollar to then pay off debt or purchase a vehicle or buy a cash flowing investment. And what it's doing is it's giving me that spread. If I'm making 3 to 5 and it's only costing me 2, that means I'm making a couple percentage points in profit while I borrow my own money, and then I just pay myself back over time and then do it again. So I'm kind of like cutting the bank out of the picture, and then I'm actually making profit on all of my self-financing deals.
Yeah, that's interesting. I think I'd probably have to see how that laid out, because you're still paying into the insurance policy that you might not see back. Except, well, I guess if it's whole life, you could buy it back at a certain point, right? If it expires at the end of whatever the maturity date is, you get that growth back, right?
Yeah, so that's the thing with whole life is since it's whole life, it stays in force till age 121.
So you're kind of it's basically a loan off of the future potential of that life insurance policy.
It's a loan off the value of it, right? So if I put in money, that money shows up in cash, and then I can pull against that cash right now. So it's kind of like doing, if you have ever done like a home equity line of credit on a property.
Yeah.
Same concept. You're just using the collateral, as life insurance rather than real estate.
Right. But you wouldn't be able to realize that until the end of the maturity of the whole life policy. Where like a property, you could always just sell it or whatever at any time.
You could sell it if you wanted to. Yeah.
You can sell whole life?
Yeah. I wouldn't, just because if you're borrowing and you make more money than it costs every time, why sell? But you definitely could.
Huh. Well, that's interesting. Okay.
Yeah.
So anyway, I like what you said before though about the way you look at debt. There's not really necessarily bad debt. There's bad behavior, but you're only basically taking debt if it can pay itself off. And I'd take a pretty similar view to that. I'd say I'm almost 100% there, because you look at, but I think the way I look at it is, yeah, I think it's the same way where you go buy something. For example, if you wanted to finance a vehicle that's going to just depreciate extremely quickly,
Yeah.
and you're also that money, if you finance the vehicle now you've got interest on top of the depreciation, so you just kind of split more of a payment up, and it's just going to continue to catapult. So like things like that make sense to buy cash to me, or kind of anything else that kind of rots or depreciates. And but if you're looking at buying like a property, for example, you can lock in interest rate on a property. Some people are getting deals in the 2% right now, so you can put that in almost anything that'll probably beat 2%.
Yeah.
And in fact, if you sat on cash, you'd probably be losing money at a rate greater than 2%. Therefore, you're probably making money by even paying a loan.
Yeah.
So in a lot
I
of
think that's
cases,
on point.
so in a lot of cases, it makes sense to buy things that go up in value. And I think that's kind of what like Kiyosaki talks about that, right? And his Rich Dad, Poor Dad and things like that. You want to buy assets, and he redefines what assets and liabilities are incorrectly, but still you get the idea that he's trying to find that you can use debt if it improves the value of something beyond the interest that's going on.
Right.
Cool. Okay. So that's interesting. So that's different than Dave. So Dave says if you're going to buy a rental property, you're buying that thing cash,
Yeah, and he's missing out on a lot of the leverage and tax benefits by doing that. He probably still gets a lot of depreciation and stuff, and it's not bad. I mean, if you buy real estate in cash, you're going to be fine. So I
Yeah.
don't think he's hurting financially because of it, but I think, if you buy it with leverage, you're going to be able to go faster and also sustain longer, and you're going to have more tax benefits and more opportunities. And it's kind of the beauty of real estate.
Yeah, that's the other thing. Like, I mean, like if you're trying to be a real estate syndicator or something and put together multiple investors for a big deal, and you tell your investors like, yeah, we're not going to go to the bank, like just whatever you guys put in is going to be the equity of this. Well, then you're just probably going to be seeing a return that's consistent with something they would just put in the market anyway. Like you're not going to see a return that's really that valuable because you're missing out on the leverage of that loan. So they see much better deals. You can get like really good deals as a limited partner investing in properties because the person that's orchestrating or syndicating the deal is using a loan to leverage the amount of cash you have to get a higher return. And I think that that's one of the problems where if people try to syndicate a deal in cash, you're going to have to find investors that are okay just getting 8%. And they're like, well, I don't really know you unless you've been working with them a long time. But if you're saying, okay, well, at 18 to 22%, you can get a return. And they say, well, what's the risk here? And you say, well, it's because we're leveraging, where there's going to be debt on this property and some other risk. And then they say, oh, that makes sense. Okay, I'm in. So it's just kind of a way of thinking about, a lot of people listen to this, invest in real estate, and some of them are syndicators, but it's about making a juicy appeal for people as well. But yeah, I know. I think that you miss out on things in property investing if you do it all cash. Like you mentioned, you still get depreciation. You miss deductions on interest. You miss the idea of leveraging capital, which is the most beneficial. If you give me $250,000, I'm going to buy $1 million rental property. I'm not going to buy a $250,000 duplex, right?
Right.
It's just kind of like you don't get that opportunity. Then it's going to cash flow and it's going to pay itself off while I sit here and podcast.
Yeah. 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 And I think there's like within real estate, especially when you start getting into like investing into it, there's like the commercial deals, which are, in my opinion, like there's a lot less to talk about there from a behavior standpoint, because the banks will make you put 20 to 25% down.
Mm-hmm.
When you're in residential, I see a lot of people where, they either under leverage, they buy all cash, or they over leverage, they do the FHA fourplex, and then they don't cash flow. So like on that, I'm still a proponent of let's bring big boy money to the table and let's still put 20% down. Because I'm buying cash flow at that point. I'm still going to use leverage. I still get 5 to 1, but my spreads are definitely there on a 20% down versus 0 down or 3 down.
Right. Yeah, I think that's a great approach. But yeah, talk to me a little bit about your you recommend investing in different passive resources. What are some of the ones that you recommend to your clients?
Yeah, so a lot of what I'm doing with my clients are, private placement type investments. And so for those that are listening, I used to be a normal financial advisor. So there's what I consider retail investments, which is the mutual fund and the ETF and the stock
Yep.
and the bond. Basically, those are financial products. I don't consider that that's investing. I would call that financial consumerism, if anything. Then we get into like investing, and I can either go two routes on this. I can do it myself, or I can say, I'm looking at a factor of return on time invested. I want to leverage other people, and that's where I might do like a private placement deal, or you mentioned syndication. And so a lot of my clients that I work with, they're successful in their lives. They have families, they have careers, and so they're not really going to do it themselves. They're looking at how can I get into something that gives me the benefit of it without the cost of time and really getting involved on a day-to-day basis. So for initial, like starting out with investors, I really am a big fan of secured private lending. A lot of my business is built around mimicking what banks and institutions do. Banks lend money. There's a reason why banks don't say, hey, let me partner with you on the deal. They say, no, here, use my money and you just pay me every month and we
Yeah.
don't have to talk about it. And so we do a lot of secured private lending recommendations with our clients that are just starting, because it's good cash flow. It's going to give them that 8 to 12% consistent return. And there's also a very good downside protection. If you've got strong loan to value ratios, you're working with a lender that has or a borrower that has a good track record, it pretty much is like going to just pay you, and after 5 or 10 years you can do another one, and it's just not something you've got to worry about or think about. And then also it gives you the ability to still produce the income. I see a lot of people, they do the first rental, and then because of the first rental on their triangle, they stop doing the income because now they're doing repairs and remodels and upgrades on this rental. And they stop doing the very thing that caused them to be able to save enough money to buy that rental in the first place.
Right. Yeah, that's a great point. And that's kind of brings you back to like my house flipper example, even like if he worked a normal 9 to 5 job, you could probably find, especially if you have a college degree and something realistic, you could probably get a job for $60,000 a year.
Yeah.
And you could sit there at a cubicle and enjoy the benefits of paid time off and health insurance and all these types of things. And you could just stack up some cash and throw it at a rental property, and you could make that passive. So I hate the dichotomy. I talked about this on a podcast. It'll either be released probably after this, but I talk about this dichotomy that happens a lot between this corporate entrepreneurship difference, and to me, it's just not a difference. It's just like, look at yourself as a business. How are you managing your assets, your time, and your energy?
Yeah.
How do you get the best bang for all of those? Right.
Yeah. Yeah.
So tell me, so that's, I think, great because it's different advice, and I like it because, yeah, you'll go to a normal financial advisor and they'll tell you things. Hey, here's some mutual funds, or if I represent a certain agency, they're going to push those types of mutual funds at you.
Yeah.
And whatever. It's like, dude, it's not that hard. You guys can figure this out. If you want to if you're in the mutual fund camp, you can go on, E-Trade or something like that and buy a Vanguard fund or whatever. It's not hard. You don't need to be paying somebody to tell you to do that. You can go find one that matches the S&P or an index fund that matches the entire market and just sit on it. And that's fine. You can do that if you want. But I think what you're getting at is where it would be very helpful to have somebody brokering deals, like finding peer lending. Like that's one of probably the easiest possible ways to make money, is being able to lend someone money for usually that I've seen, like pretty good interest rates. Some cases, north of 10% for just some guy to use for whatever reason. Are you doing mostly like secured or unsecured, or does it matter?
Yeah, ours are all secured income deals.
Okay.
So we're looking at like, for example, a 5-year note on a mobile home park that's going to pay a 12% annual simple interest as monthly cash flow. That's a freaking great deal. I just put my money in the park, 50% loan to value. So if they default, I'm going to get twice the money I put into it. So they have a very high incentive not to default. And so that's a great deal for an investor. I stay away from flips. My attitude with flips is you could just do that on a credit card. So if you're coming to me for money on a flip, I'm going to charge you more than a credit card, And if you're not willing to do that, that tells me what I need to know about your deal.
Right.
So I kind of stay away from flips on that respect. But I think a good secured income deal that the cash flow produced by the deal exceeds the interest being paid to the investor, it's the same deal banks do, right? And that's a very stable deal for someone.
Now I know banks have this is, I guess, more getting into the model of your business in a way, but like banks have sometimes inefficient ways of managing the assets that they repossess. Do you manage those, or how does that work? Like if someone does default on their payment, are you the one going to collect the notes now on their property, and then do you put that up for auction? Is that part of your operation, or is there some other deal
No,
with it?
so we outsource that. Basically, we've never had a default happen. We work with a very small amount of investment providers. My favorite one, they've been in business 40 years and they've never not paid an investor. And that's not a guarantee of anything, but fingers crossed they can keep up that track record. So we've just never had to put up with it. And we vet it so well that newbies are not going to get in. Like, we're not going to have our clients lending money to someone that doesn't have a very reputable track record and a strong history that shows us that they have a small chance of ever defaulting. So if it did happen, we would have a lot of outsourcing that we would put into play on that. The contracts we have are written such that it's uncontested. The borrower knows they're in default. They know they're going into foreclosure. So the legal side is not bad. And if the property is still occupied, my advice to the person is, you own it, keep it. It's paying you the full gross rents now, not just the
Right,
interest
because they would
earning.
have that property. They would have
Yeah.
the rights to it. Yeah, that's cool. I think that's a lot different than you get from most financial people. That's one of the appeals, I think, of having you on this show versus just a standard cookie cutter, go down the street and go walk into some, Edward Jones or whatever and listen to what they have to say. Because it's hard to find, for someone that might have some money aside and they might say, hey, I'm looking to maybe get into peer lending, or I might want to invest into real estate. Where do I start? To have someone that has that network built up is much more helpful than trying to build that network yourself, right?
For
Because
sure.
like where do you find limited partnership deals? Usually
Yeah.
in the locker room of a country club, or just if you're hang out with high net worth individuals, like that's where you find those deals. They don't just come across your desk. You can't Google them. It's really hard to find people that are syndicating deals. So you having built up that network seems to be very valuable for people.
It definitely is, and we've turned it into a system. And part of it for me was when I was a financial advisor, I actually gave that business away, right? So I built it up. We were doing a few $100,000 a year, and when I started learning about what actually happens in the stock market, things that I didn't learn on my licensing exams, I started learning about what really is going on behind the scenes, and I was sick to my stomach when I learned that stuff. So I was like, I can't do this anymore with my conscience and in my own personal integrity. So I gave that business away. And then I was kind of like, well, what do I do now? Right? Like, I don't have a product, I don't have a business. And it started there with, my best friend's dad. His name is Chris. He's been wealthy, financially independent since I was in middle school. And I never knew about it until later on in life. And so I had a conversation with him, and that's what he did, is he invested in real estate. And so he started telling me about private placement deals. So that was the first thing, is like, okay, well, I know I can help people with that now. And so we just kind of started building that network out to now where it really is turnkey and people get plugged right into it. And they just follow step by step into, each phase of our blueprint. And really it takes them there. And there's a lot less work of them having to blaze the trail. Because for me, it was not something anyone had ever done before. So I had to go figure out all of this stuff by myself and do all of the research and talk to all of the people. And it really is the idea of the needle in the haystack. And so we just found the needles and said, screw the haystack. You don't really need that thing. Let's
Right.
just use the needles.
Right. Um, let's go back for a second to kind of when we're talking, Dave Ramsey. For those of you that don't know, Dave Ramsey is kind of a household name on the side of personal finance for being, I think, reasonable and have a lot of common sense with the way he gives advice to people. And he gives advice, not necessarily financial, but sometimes spiritual and other aspects. And he's got a very popular platform and a lot of books written on how to manage and get out of debt and get to that next level of wealth. So in a world of people that are just, in a addicted to consumption, I think he's a breath of fresh air in some levels. But one other critique of Dave is I don't know if he's helping people at that peak performance level, or people that kind of like get to a position that's like, I get it, I'm financially healthy, I've got a thriving business, I'm stacking up dough, like what do I do? I don't think he gives a ton of advice in that area so much, as more of people that it's like, you think you have problems, listen to some of Dave's callers. I mean, like they'll make you
Yeah.
feel like you're having a great day. But I guess on that note, I have two questions. The first question is kind of, what's the advice for people that are at that higher peak level? This is kind of like, hey, let's get you into more peer lending options and syndications. Is that kind of how you frame the conversation with those types of clients?
Yeah. So for me, that level, and tell me if you're on the same mind track with this. For me, that level is when someone becomes an accredited investor. So when
Yes.
they get
Yep.
$1 million net worth, at that point in time, and for those that are listening that didn't know this, there's an accredited investor. There's a couple ways to measure it. My favorite way is just $1 million net worth, excluding the value of your house. When I become accredited, there are deals that I am allowed to know about and invest in that legally I was not allowed to know about and invest in prior to being accredited. Usually there's better returns, better tax benefits, all of this stuff that it really is like the curtain gets pulled back. And now I get to go to like that smoky back room where all of the rich people actually hang out. Like that's kind of like being an accredited investor.
Right.
So when
And
someone
there's an
gets there,
income too with that, right? That's it. Was it 250 or 300,000 if you're married or something?
yeah, as an alternative, I don't like the income one though, just because that
Doesn't.
it's AGI, so that means that I have to pay taxes on 300 grand, which I'm not going to do. Right.
Right.
So if I if I want to be accredited by income, it means I'm paying through the ears in taxes to get there.
But if you're a lawyer or a doctor listening to this, that you have, $500,000 of student loans, but so your net worth might be dog crap, but you have a high income, there's still options for these guys too, I
There's still
guess.
options, yeah. So there's definitely an income qual. So when someone gets to that level, the first thing we look at is some of these alternative assets. So we start getting into some very unique assets that have tax benefits. And excuse me for being kind of vague, just because I'm not legally allowed to talk about them. Because if you're not accredited, it's like fines and things. So there are great tax benefits and things you can do there. But a lot of what we're talking about is like at that point, we've probably already done a few deals. We already have some cash flow. We've already been saving 40% of our income. A lot of what we're doing at this point in time is looking for unique tax reduction strategies coupled with those assets. So, things like oil and gas and charitable lead trusts, different things that allow me to take large amounts of my income and write it off on my taxes, but still keep that asset and invest it for cash flow down the road. And that really is from the 1 million to the 5 million marker. That's a lot of what's going to keep me, moving forward, is the fact that I can get my tax rate. If I was W-2, let's say that lawyer, I might be in a 37% tax bracket. If I'm accredited, I can help that guy literally pay zero and
Mhm.
still keep the assets. And so that's going to be a very, very big factor in making faster progress, just because of the amount that I can keep now that I didn't used to be able to keep aside from my 401k and my IRA and my HSA.
Right. Yeah. So I think that's helpful. And I know there's a level below accredited as like a sophisticated investor. And once again, I am not a lawyer. I have zero financial or legal credentials other than I like money and I look at it and I like to try to make more of it. but there's a sophisticated investor too, which I think is the idea of to some vague interpretation of having knowledge enough to be mature to make some type of, I don't know all the rules. You probably know
It's
better than I do.
it's worded almost exactly like that. It's like
Yeah.
I
It's like
kind
really
of
vague and
I
weird.
kind of sort of halfway know what I'm doing a little bit, and I think I can disclose that I won't sue anyone if I do this deal and it goes wrong.
Yeah. So when you're syndicating a deal, there's certain rules you have to follow if the deal is going to apply to sophisticated investors versus accredited investors, as far as like the knowledge, how much you can raise from them and who and stuff like that. But like I said, I'm not an experienced syndicator. I'm learning that as we go. But I guess the long and the short of it is even if you're not an accredited investor, if you are a student of the game and you can maybe be qualified as a sophisticated investor and still maybe get your hand on some of these deals too.
Yeah, and that's part of it. Like the sophisticated side, most funds can do 35 of those. non-accredited guys in their fund. And there's all sorts of structures, but the typical fund I see can do that. And it's really going to be like, education, and it's some sort of financial qualification. So within our program, like I was mentioning, people getting to those deals where they're doing private lending and getting those 8 to 12% returns, that's going to be a sophisticated investor. We've actually tailored a way for them to actually like check the box off. So we have a program called Wealth DynamX University, and it's training. They're gonna go in and learn and get educated so that they can actually come out of that and say, okay, I actually feel like I've got my legs out from underneath of me. And then we're also going to help them pay off their debt and get their 6 months in reserves. And at that point, we can say, yeah, you're definitely sophisticated. You
Sure.
know what you're doing. You're solvent. Nothing bad will happen if you do this deal. And so it kind of helps people really graduate into that. And then that's really good for the fund too, because they know they're not working with, Billy, who really shouldn't have done the deal and had his job, go away during COVID. And now he's calling and saying he wants his money back.
Right. Yeah. No, that's a great idea. And I think that's why it's helpful to work with someone like you is going to open the door to different options. That's just relieving because you get so much of the same cookie cutter advice from financial people just right around the corner. And I think the hard part is like why the rich get richer, if you will, is because they know things that the rest of the world doesn't know. Like you said, it's like this veil that opens up and you get to go into the cloudy, smoky back room. And that's why having people like you or the service that you're offering is to kind of bridge that gap in a way. It's like, hey,
Yeah.
you're a normal guy, you got a job, you're doing well. Here, there's some better options, I think, that are out there. And everyone's like, well, what's the catch? What's the catch? It's like, well, the catch is you just couldn't find these deals. Like you weren't looking because you weren't told about them. You were told to go look at your E-Trade account and buy Vanguard mutual funds your whole life because that's when people stopped learning. Mm-hmm. Which kind of brings me to that second question. So you talked with Dave. We're talking about Dave, and we said the two things he missed was health and knowledge. Tell me a little bit about knowledge.
So knowledge is big. I think this is something I think Dave practices. I just don't think he talks about. Right. So
yeah,
I'm a firm believer that I am my greatest asset. As an entrepreneur, I've had ideas that made me millions of dollars, and it was like just boom, right, instant. And of course, I implemented them and followed through on it. But like a property can't do that. If I buy a property and it's an 8 cap rate, I'm not going to make very much more than that or pay me much sooner than every month. And so the idea of knowledge is, like it helps me now and later. When you're building wealth, if you study wealthy people, a lot of them go through this phase of they started in business in some way, shape, or form. That takes knowledge. And then they started turning that into investments. The investing is kind of like, I don't want to say less knowledge, but it's very standardized, right? Mm-hmm. Like, excuse me, buy a property that cash flows, make sure your numbers are there. And that's kind of the extent of the knowledge. You get to a certain level around the $10 million marker. And a lot of these wealthy families, they started something called a family office. And a family office is their enterprising of their wealth. They're financially independent already. And now they're looking at legacy, and they're looking at acquisitions, and they're looking at basically almost like a venture capitalism type structure. And that takes a lot of creativity, and it takes a lot of human inspiration. And you can't do that if you haven't invested in yourself. Mm-hmm. And so that's big for me. Like I spend more money than any other category in my life than just on my own personal development. And I'm huge on that. And I think that for the average person, we go through school and then kind of just stop. And yep. Whether it's finances or whether it's health or whether it's politics, our lack of responsibility for our own knowledge is the sole reason why we can be taken advantage of by, corporations, governments, IRS, whatever it might be. And it's even hard to point the finger and say the system is rigged. It's not rigged. It's all in books, and we don't read the books, right?
They're all there. The books are all there.
Yeah. So I would say that's kind of my stance on knowledge is I think everyone should be starting there. If I'm trying to increase my income, I've got to go learn something. I've got to be, and this is another triangle we have. It's called the triangle of exchange. We're trying to get the income up. We've got to have knowledge. That's the first point. We've got to have value, which is a byproduct of that knowledge. And then we've got to have exchange with other people. Mm-hmm. And so even at the basic level of like, hey, AJ, I'm trying to make more income. That's a conversation of great. What do you know that others don't know that makes you valuable that you can then go exchange with them to get the income?
Hmm. Yeah, that's brilliant. You see that a lot with people that they have a ton of information in their head, but they can't get that out there.
Yeah.
Or they got a ton of information in their head that's not really valuable. I think that we all have a friend that knows like every detail of like a video game or something, and
Yeah.
it's just like, hey, yeah, that's just like all just useless knowledge or whatever. And it's like, yeah, it's probably useless knowledge, so it's not valuable. But then there's these, I like that three-way, that way of thinking of it, because to your point, it's like everyone thinks this is like secret. It's like, no, there's just people that are interested in learning more. And that's how
Yeah.
it's in books, it's in podcasts, it's like asking harder questions. But we're right, we freeze. We say our 4-year education in high school or our 4-year education in college is sufficient for the life that I want to live. That's just incorrect, because like, think about it. You only have, if you really boil it down to maybe like 1 or 2 textbooks per class in 120 semester credit. So what are you looking at? Maybe like 250 books that you've ever even really touched or looked at, and you think that's going to contain all the knowledge of the universe. It's just like, that's not how it works per se. I think that there's
Yeah.
so, because you kind of, there's this mindset shift you got to go through to realize that there's opportunity and new information to learn. And then there's, how do we vet all that opportunity to figure out what's going to work for what I'm trying to do?
Yeah. And I think there's a category too of like, and I've been here as an entrepreneur where it's almost like study, 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 but then never apply. And I see a lot of people fall into that too, where I, to your point of, I know stuff that's not important or valuable. Sometimes it's also, I know stuff that is important or valuable, but I never actually learned how to apply what I've read.
Right.
And that's a turning point going from, and it's how I study now, where if I study something and I can't instantly apply it, I don't move on to the next chapter. I go back to the beginning of the chapter I just read and figure out, what did I miss that I can't apply what I just read.
Right.
And that's not ever taught. Like, I didn't learn that in school. I didn't learn that. That was school hard knocks. That was like in
Right.
business. I learned accounting, and my accounting did not turn out good. I don't need to move on to taxes. I need to go back to accounting and figure out, what did I miss in accounting. And I think that that's really the idea of, with knowledge, for me, it's deep, not wide. I would
Hmm.
rather read the same 5 books over and over and over and really get them and apply them than say I read 52 books in a year on Audible, where I didn't actually read them. I just heard things, and I can't really apply most of what I read. And so I think that that's a level of desire that has to be there for somebody to do that. It's kind of like working out. The guy that does his squats all the way to the floor versus the guy that goes a quarter of the way down.
Right. I 100% agree, because Jim Quick, who, if you guys aren't familiar with Jim Quick, he does a lot of a discussion, and he's written books and has a podcast around kind of like just hacks with your mind, how to become more intelligent, how to memorize things better, and all this stuff. And people ask him a lot of times, like, what is the best way of reading retention? How do you memorize things? And he says one of the things is, you look at what you read, you reframe it in your own words and apply it in a scenario like you're talking about, because
Yeah.
that's going to be the fastest way to understanding. And understanding is essentially your comprehension and your retention. The
Mhm.
faster you can do that. And my wife always, she's like, she was just talking about with me yesterday. She says, I don't understand how you can just like read or listen to something and know exactly what they were talking about when it's like kind of an abstract or a lecture or whatever. I said, for the same reason, it's you apply it, you figure out a scenario where this could be applicable and say, I see what is happening there. I love that advice, to not like move on from a chapter or even a page until you figured out what's going on here.
Mhm.
And taking the time to do that, because yeah, you can read stuff and just forget the points right after you're done, but you can say, yeah, whoop-de-doo, I freaking finished a book.
Yeah. And it's for me, it took a lot of discipline because I'm a target oriented person. So
Yes.
when I'm reading the book, I have to fight the little guy in my head that's just like counting how fast I can finish the book.
Right.
Right. And so for me to go back is almost like agonizing sometimes. I'm like, oh, I'm going to go read this chapter again. I just read it and it's going to slow me down. But again, it goes back to what's the purpose of me reading this?
Yep.
Am I reading this to say I read it, or am I reading this because I actually wanted to know something? And it's because I wanted to know something, and I'm going to go back and redo it.
Now, when you're reading, are you one of those guys that just kind of sticks to a particular genre, or you find value in things that might be unrelated to your industry?
So I find value in a little, like, all sorts of things. So in my industry, So there's certain books that I've read in my industry that really helped, and so I've read those and I keep those on hand. But a lot of the stuff like that I learn about is not really like books. It's like going and reading the tax code,
Sure.
or so it's more like
Like
data.
technical kind of stuff.
Yeah, exactly. So it's more like technique and know-how and very technical or specialized. I'll spend time doing that. I was explaining this to one of my employees yesterday. It's kind of like staying hydrated.
Yeah.
Like there's a baseline amount of water I need to drink every day, right? And so most of that for me in the sense of reading is going to be personal development. I love learning about the mind. I think if I know how my mind works and how other people's minds work, that's priceless. There's so much clarity that comes in life from that. So I
Right.
love that. Love learning about business. I love reading biographies. I call them old dead people, right?
Yep.
If they've died and I can look at their whole lifespan, then I don't have to worry about what's going to happen next, right? So I love that. And so those are a lot of the things that I'll read, and I will look at, like with everything, how do I apply this in my business? And then there's also like the water thing. There's my baseline, and then there's also like times throughout the day where I might need a little more water than I needed at a different point. I just got done working out. Let me drink something.
Right.
That's where I will take like specialized knowledge of like, okay, I'm doing this tax plan for this guy. I need to go research such and such. And that's like a little sip that I just got. And so that's kind of how I do it, if that makes sense.
Yeah, no, I think that makes great sense. Yeah, the reason I ask is because there's I've seen I guess just with the political climate and a lot of the dissent, and we'd never really talk politics on this podcast for good reason, right?
Yeah.
But I'm like, what's the deepest level of philosophy and things, and people who haven't even read different thinkers and different philosophers? You hear the words, like you hear like John Locke and Karl Marx, and people are like, ooh, Marxism bad, or John Locke is bad. And it's like, have you read either of them? And going back to reading classics and how it applies to your philosophy, and how your philosophy applies to your life's worldview, and how your worldview applies to the way you think, and how you think impacts other people and how they think, and your mind and how your mind works. And it becomes almost like a staircase, if you will, that you go from worldview to your psychology, to your behavior, to the things that you do, and then it manifests in results that are things around you, right?
Yeah.
And it's like, so there isn't like a level too deep. So I've gone back and read a lot of philosophy and literature, things that I hated reading as an engineer that just seemed irrelevant, of like, why would I read a poem? You know what I mean? And it's like, that's kind of one of the things I've looked at as far as reading, and I don't think there's any genre that should be off limits, because to your point, I think you can learn and apply just about anything, even in fiction. Watching how a character solves a problem, you'd be like, oh, maybe this might work. It's just so reading is certainly a valuable skill. And I always encourage people to kind of like check out my reading list, or if you have do you have like a recommended book that you think, like, based on the conversation we've had today, this would be a good level read for you guys?
Yeah. One of my favorite books, it's called Becoming Your Own Banker.
Okay.
And it's by a guy named Nelson Nash, and he passed away last year, but he was a real estate investor, and he's the guy that I actually learned that we talked about life insurance earlier, that you can do that. So he basically tailored that concept out and made that popular, but it's a very he took a very technical subject and made it very simple, and it's also very philosophic as well. People don't realize money is a spiritual thing, and so he kind of dives into that as well. So that's a really good starter book, just to kind of get ignited on the mindset of some of the stuff we teach.
Sure. If you don't mind me asking, like, what kind of underlying philosophy was it?
So it's really the idea of kind of cutting out the middleman in your transactions, right?
Sure.
So money is an exchange point, and so exchange it back and forth between each other, and that's spiritual in nature, regardless of your denomination or religion.
Like a promise or something, right? Like it's almost transcendental.
It's trust, yeah. And so that's kind of the idea behind it. And so he's talking about, obviously capitalizing on that, but also the idea of taking responsibility to become like your own bank or your own storehouse.
Right.
And depending on how deep we want to get into this, if you study back, historically, banks have never been a good thing. Every country that's gone down in stature, it's been done through their currency and because of banks that ultimately got involved and muddied up the waters of their politics and their governmental structure. Same thing is happening today. So there's kind of this idea too, if you understand that about banks, then you start looking at, okay, why would I want them suppressing my financial lines, and how do I get them out of there? And this is aside from maybe using them for leverage on a property. That's where I have more good than there is bad, kind of like chemotherapy, right? Like it's poison, but also it might help.
Sure.
And so that's kind of the idea behind it, is like, if you start really looking at your finances in that way and taking that level of responsibility, it really is a game changer on, how much you can make, but also how much you can keep. And also, because of the legacy aspect of it, looking at your future generations as well.
Yeah. Yeah. Right on, man. That's, I'm sure there's much more to that book, but one of the themes that you mentioned too, are just about that kind of like promissory note that really what money is. Like I hand someone paper and there's kind of a transcendental implication of value associated with these transactions. Like I got an argument with a really avid Dave supporter about the debt thing. And I said, well, we're sitting at a coffee shop right now and we're drinking coffee. Have you paid your bill yet? And he's just like, well, no. I'm like, well, right there, you're carrying a debt or you're carrying a debt to a creditor at this point right now because you haven't paid your bill and you drank your coffee. So it's just kind of like people don't realize how fine of a line it really is to say things like all debt is bad. It's like this transcendental value promise. So I'm glad you brought that up. And I think that would be a deep and interesting book that I've not read that I think would be really, really fascinating.
Yeah. And on that note too, and no, this is going to sound funny now, but the idea of debt, right? And when I was a Dave guy, cash is king,
Yep.
Debt is dumb. Whenever I talk with someone that's really that, fixated on debt is bad and I have to use cash, I just show them their dollar. On their dollar, it literally says, Federal Reserve note. So their cash is debt. And so that kind of just busts the argument in half right there. Money is debt. That's what it's backed by. That's how it's created. There's no such thing as true cash anymore. So for somebody to say debt is bad, cash is king, yet the cash they use is debt, that shows me that there's something about money fundamentally that person doesn't understand. And Dave doesn't get into those things on the radio.
Yeah, he keeps it as simple as possible because to understand, like I said, I'm 85% with Dave because of those reasons. Like he simplifies things so that people that might be new to money or they might be struggling with it, he can provide very simple rules and tools that will work. They will work. Sure. They will work.
Regardless of what you know about the background of money, you can apply those things and it will work.
Yep. So, but to our deeper level of the understanding, we're kind of getting into more of like this common value, but that'll be for the next tier of your journey, I guess. We'll end on that note. But Jerry, listen, hey, if we have, if guests or listeners or people want to get a hold of you or get involved or maybe even invest with you, how do they get a hold of you? How do they follow along on your journey?
Yeah, so you can go to any social media platform and just look me up, Jerry Fetta, Fetta. It's like the cheese, right? It's with 2 T's though. Great cheese, but it's twice as good because the 2 T's are there.
That's right.
And you can find me on that. If you go to jerryfetta.com, I wrote a book called How to Create Wealth, and you can get that for free. I do live in Alaska, so you're going to pay for your shipping. It's like $7, but it's still a great deal on the book. And that's a great place to start. And just, we do a lot of free content every week. We do a free wealth creation course on Friday nights. That's on Instagram, Facebook. We post that on YouTube. So if you can find my content, just follow it. And if it makes sense, reach out and we can help you.
Awesome. Well, Jerry, thank you so much for coming on the show today. You guys are listening to Winners, Wallets, and Worldviews podcast. You can go listen to this podcast at aaronjarmstrong.com/podcasts, or you can also leave us a review on any Stitcher, Spotify, iTunes, Google Play. If this helped you, if you agree, disagree, leave a 5-star review and some comments, and we'd love to hear more from you guys. Thank you so much, and be somebody.